When you're self-employed, you have to juggle the unique roles of being both the employer and the employee. Although freedom and independence are pretty fantastic benefits, they also can bring irregular cash flow. This is why you should plan for unexpected changes and retirement accordingly. Hi, I'm Brandon, and I'm a certified financial planner. If you find value in this video, please give it a thumbs up and subscribe. Feel free to ask any questions you have in the comments below, and let's get into it. In the case of self-employment, there are 3 different approaches to planning that we'll talk about today. Let's start with the TFSA, RRSP, and RRIF or RRIF. This stands for the Tax-Free Savings Account, Registered Retirement Savings Plan, and Registered Retirement Income Fund. These allow you to plan for the future and save on taxes. TFSA is a perfect tool for freelancers that are just getting started. Why, you ask? The benefit of holding investments in your TFSA is that they grow tax-free, and you can withdraw your funds whenever you want, perhaps during times of hardship. Contributions to your TFSA, however, cannot be deducted from your tax return. In this case, TFSAs and RRSPs may be better if your income exceeds $80,000 a year. Once you reach 6 figures, you should maximize your RRSP contributions and certainly make some TFSA contributions. That's because there's a good chance you'll be in a lower tax bracket when you stop working. Furthermore, once you convert your RRSP to a RRIF or an annuity and start drawing it down, the cash you take out will be taxed as regular income. Now, the IPP stands for Individual Pension Plan, which is a registered, defined benefit pension plan, typically set up for a single individual or a number of shareholders of a business. This plan allows you to build your retirement income under a tax-sheltered umbrella. As long as contributions remain in the plan, you will not be required to pay taxes on the contributions by the business. An incorporated business sponsors the plan for its owners or executives. Furthermore, you'll be able to receive the maximum pension that is allowed by Canadian tax law. There's a few advantages to the IPP that you should be aware of. One is that you generally are going to have a higher maximum contribution limit than the normal RRSP. Income splitting can also be allowed between you and your spouse. However, keep in mind with the RRIF, you must wait until you're 65 years old. With IPPs, the participant can buy back previous years of service upon the plan's implementation, and then you could actually end up receiving quite a bit more. Many business owners will wait until they're actually older and then buy back, but you do of course lose some of the tax-sheltered time over that period. Returns of course are tax-sheltered with any of these accounts. That could be in the company's contributions as well as the individual's contributions. There may also be the ability to deduct some of the administrative costs associated with the IPP on an annual basis. There are also some benefits from a legal standpoint with an IPP, in which case those assets are difficult to be seized by comparison to an RRSP. If you need to take out a loan in order to fund the IPP, that loan could be potentially tax deductible. Now, with all these benefits, there are of course some shortcomings. There's the setup and administration costs to the IPP, as you need to work with an actuary as well as a financial advisor. The participant will have almost no new RRSP contribution room in their RRSP, so they really would be using all of your contribution room in order to use the IPP. The participant will almost always have no extra RRSP room and therefore would not be able to contribute to their spouse's RRSP. The company must continue to pay a salary instead of dividends, which could mean additional costs since the annuity is based on salary. Additional contributions may be necessary if returns are insufficient. Employees who hold 10% or more shares of the business sponsoring the plan are eligible to participate in an IPP. In the event you are over age 40, earn more than $75,000 a year, an IPP may be more beneficial for you than an RRSP. Contribution can be much higher than the RRSP's limit, therefore enabling you to save more for your retirement. Lastly, we have the personal pension plan. A monthly taxable benefit could replace part of your income when you retire. The Canada Pension Plan requires contributions if your net self-employed and pensionable income exceeds $3,500 a year. Contributions may be made through work you have done in Canada or from credits received from a former spouse or a former common law partner at the end of a relationship. To qualify, you must be at least 60 years old and have made at least one valid contribution to the CPP. If you qualify, you'll receive CPP retirement pension for the remainder of your life. A common misconception about the CPP is that you need to stop working to start collecting, which is false. Remember, the CPP is not automatically available to you. You must apply through Service Canada. Suppose you're unsure when to take CPP. In that case, consulting with an experienced advisor or an accountant can help you sort out all the details and determine which age is most appropriate for your situation. Some things to consider are longevity, how long do you plan to live for or expect to live for, as well as how much income you're receiving through other sources. Thanks so much for watching. Please leave a like and subscribe if you found this video helpful. Any questions or comments, please leave them below. Thanks, and we'll see you soon.